Across the United States, something fundamental is shifting, and it should concern anyone who's paying attention, not just investors, not just economists. Anyone who owns a home wants to own one, or believes housing is supposed to represent stability rather than stress. In quiet pockets of the country, some rural, some suburban, some once booming metro corridors, places that once felt permanent are starting to feel temporary. The early signs don't look dramatic. They never do. A few more for sale signs than usual. Renovations that stall halfway through. A neighbor who leaves without saying much. Then it accumulates. Empty driveways, overgrown lawns, houses sitting dark at night, local businesses reducing hours, fewer kids outside, less noise, less movement. It's a kind of silence that doesn't feel peaceful. It feels abandoned. This is not a normal seasonal slowdown. It isn't a healthy pause after years of growth. And it isn't a harmless cooling off. What's happening now is something deeper. The math that makes home ownership viable is breaking down. And when the math fails, the culture built on it starts to fracture as well. For decades, the American home represented more than shelter. It was security, proof that effort led somewhere, a place to anchor a family, store memories, invest sweat equity, and build long-term stability. It was the foundation of the middle class. But that foundation is now under strain from every direction at once. Financing is more expensive. Insurance is unstable or unavailable. Property taxes keep rising. Repairs cost more every year. Wages haven't kept pace. And the exit plan people relied on, the assumption that you could always sell for a profit, no longer feels guaranteed. We're entering a phase where owning a home increasingly feels like renting from 4 different entities at once. The bank, the insurance company, the tax authority, and the utility provider. None of them negotiate. None of them care how tight your budget is. And when that reality spreads far enough, markets don't gently adjust. They reset violently. This is not just about falling prices. It's about confidence, about whether Americans still believe a home is a safe place to park a lifetime of savings, or whether it's becoming a liability disguised as an asset. Nowhere is this clearer than in the states where the warning signs are flashing brightest. Let's walk through them. Number 10, Washington. Washington's housing market isn't simply slowing, it's deteriorating from the inside. For over a decade, the Seattle region rode an extraordinary wave. Tech expansion, rising salaries, a constant influx of skilled workers chasing opportunity. Neighborhoods across Seattle, Bellevue, Tacoma, and beyond were priced as if growth were permanent. In parts of King County, median home prices pushed past $800,000, numbers that would have sounded absurd not long ago. But housing markets don't live on optimism. They live on income. And when income growth stalls or reverses, prices lose their support. As tech firms cut staff, startups shrink, and remote work flexibility disappears, demand hasn't softened, it's vanished. Inventory has climbed sharply. Sales have dropped to levels not seen since the aftermath of the last housing collapse. Homes are sitting longer. Buyers are cautious. Sellers are growing anxious. Mortgage rates, near 6.8%, have completely altered affordability. Monthly payments that once sat near $2,900 are now pushing $4,800 or more. Add rising property taxes and maintenance costs that have jumped nearly 20% in a year, and even high earners are feeling pressure. When the upper end of the income spectrum starts struggling, the entire market loses its safety net. That's why nearly 1 in 5 sellers is already cutting prices aggressively. This isn't confidence, it's survival. Washington's vulnerability is concentration. Tech and aerospace generate enormous wealth during expansions, but they contract sharply during downturns. Layoffs ripple outward, draining demand from restaurants, contractors, service workers, and local businesses. Housing absorbs the shock. Add rising crime concerns and worsening homelessness in key neighborhoods, and families begin making decisions based on security rather than status. Outside Seattle, markets like Spokane and Yakima show similar stress, more listings, fewer serious buyers. When recession pressure intensifies, Washington's housing market is unlikely to bend gracefully. In the most inflated areas, it's more likely to crack. Number 9, Nevada. Nevada's housing surge was never as solid as it looked. It was built on momentum, speculation, and a tourism-driven economy that requires constant motion. For years, Las Vegas symbolized expansion without limits. Construction cranes everywhere. Investors flipping homes like casino chips. Confidence feeding on itself. But Vegas knows a hard truth better than most places. When momentum shifts, it doesn't slow, it swings. Median prices around $455,000 look stable on paper, but sales are down sharply. Inventory is up. Entire neighborhoods in Henderson and North Las Vegas are lined with unsold homes. Affordability has collapsed. Mortgage payments exceed $3,600 a month for many buyers, and insurance premiums have surged. That's colliding with an economy already under pressure. Nevada lives and dies by tourism. When visitor spending slows, income disappears fast. Tips vanish. Hours get cut. Service jobs evaporate. And mortgages don't pause because the Strip is quieter. Investors are retreating. Nearly a quarter of sellers have reduced prices. Homes sit longer than they have in over a decade. Developers are offering massive incentives just to clear inventory. Add water scarcity and regulatory pressure into the mix, and future growth becomes harder to justify. Vegas still shines at night, but the glow doesn't pay mortgages. Number 8, Utah. Utah's housing boom was marketed as proof that growth could be clean, controlled, and sustainable. Silicon Slopes was supposed to be the future. For a while, it worked. Prices surged. Demand felt endless. People moved in expecting stability. Then rates rose. Tech slowed. Demand evaporated. Median prices above $560,000 no longer align with local incomes. Sales are down nearly 20%. Inventory is up close to 30%. Homes sit longer. Price cuts spread. Mortgage payments now consume over 40% of household income for many families. Add rising utilities and maintenance costs, and ownership stops making sense. Utah also faces water constraints, air quality concerns, and infrastructure strain. Once population growth slows, the housing model weakens fast. Markets built on optimism tend to fall hardest when sentiment turns. Number 7, Louisiana. Louisiana's housing crisis isn't just financial, it's structural. Insurance premiums have exploded. Providers are leaving. Many homeowners are forced into minimal coverage, costing thousands per year, or none at all. Sales have collapsed even as inventory rises. Homes sit for months. Buyers aren't shopping for houses. They're shopping for risk exposure. The economy relies heavily on oil, gas, and shipping. Industries facing volatility and automation. Population loss compounds the damage. When people leave, demand leaves with them. Add constant storm damage, rising maintenance costs, and flood risk, and ownership becomes exhausting. Federal aid can't keep pace with repeated destruction. Entire neighborhoods face retreat. Number 6, Arizona's boom depended on affordability and migration. Both are weakening. Median prices near $435,000 don't tell the full story. Utilities, water costs, insurance, and extreme heat are driving living expenses sharply higher. Inventory is rising. Price cuts are common. Insurance availability is tightening. Mortgage payments push beyond $3,200. Extreme heat is no longer theoretical. With dozens of days above 110 degrees, climate migration is starting to reverse. When newcomers stop arriving, supply overwhelms demand quickly. Number 5, Colorado priced itself as lifestyle luxury. But luxury only works when income supports it. Median prices near $580,000 push locals out. Inventory is rising. High-end homes sit empty. Construction slows. Tourism faces wildfire risk and unpredictable snowfall. Agriculture battles water shortages. Costs rise across the board. When renters and buyers both retreat, markets slide fast. Number 4, Hawaii. Hawaii's housing market is economically unsustainable. Median prices near $875,000 paired with average incomes under $90,000 create a brutal affordability gap. Tourism is slowing. Short-term rentals sit vacant. Insurance costs surge. Rent offers no relief. Cost of living remains punishing. Locals leave. Absentee ownership grows. Paradise becomes hollow. Number 3, California's housing system is breaking under its own weight. Prices remain disconnected from income. Insurance markets collapse in wildfire zones. Population exits accelerate. Employers relocate. Homes take longer to sell. Price cuts spread. Monthly payments exceed $5,000. California is built for wealth, not stability. Now the cracks are everywhere. Number 2, Texas promised affordability and opportunity, but costs have surged. Property taxes rise. Insurance spikes. Utilities soar. Inventory builds. Austin's correction is already underway. Migration slows. Construction weakens. Texas assumed endless growth. That assumption is breaking. Number 1, Florida. Florida sits at the epicenter. Prices soften, but insurance explodes. Premiums up over 300% in a few years. Providers exit. Coverage becomes unaffordable. Flooding, storms, erosion, and heat transform risk into reality. Migration slows. Homes sit. Costs overwhelm income. Florida isn't an isolated market. When it cracks, the shock spreads nationwide. Final thoughts. This isn't just about housing, it's about trust. When people stop believing that hard work leads to stability, behavior changes. Buying slows, building slows, families delay milestones, communities hollow out. This is a structural shift, not a cycle. And pretending it's just a cool down misses the real story. The silence on those streets isn't calm. It's the sound of something breaking.